If you've not done a live show before, it's pretty interesting that we're smiling, waiting for us to get the little red light that says live. And it's funny how your face just kind of does that fake smile thing.
Yours is fake. Mine's for real.
That's true. So here's the question: Is now a good time to invest in real estate?
No.
Let's find out.
Right after this. Thank you so much for joining us on the Passive Accredited Investor Show. We are Carolina Capital Management. We're lenders in the Southeast for real estate investors. If you are interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget to sign up with Wednesdays with Wendy.
That's right.
I feel like this is kind of a Lord of the Rings.
I was gonna say, like much like that ink dropping into the water, your mind will be blown when you talk with Wendy.
Yeah.
By the way, we have a question and comment section on the right-hand side of your screen or underneath, depending on the platform that you're viewing us from. So don't hesitate to ask or make crappy comments.
No, make good ones. Good ones. You're doing much better on this show, Bill. You got your blood moving. He remembered all the words. Aren't you impressed?
I know. Your face is less red.
Yeah.
I mean, today is your day.
Yeah, yesterday I got to the office and I thought to myself, now, did I leave my very expensive Yeti cup on the roof of my car, or did I leave it in the kitchen?
Where did you find it?
It was in the kitchen.
Oh, good for you.
Yeah,
because I have left it on the roof of the car, and that's why it's got a few battle scars. So my apologies to David Phelps and group for the dents on their Freedom Founders cup.
It's a good cup. Good cup.
Yeah, so we're constantly getting pounded with this. Is now a good time to invest in real estate?
And specifically, is now a good time to invest into
commercial real estate?
Yeah.
In the form of self-storage or maybe even multifamily, but we're going to concentrate on self-storage because we have a rock star in the self-storage industry, Jacob Vanderslice.
Superstar.
Welcome to the show, my friend.
You guys are you're too kind. Good morning and good afternoon.
So, just out of curiosity, how much square footage are you guys controlling right now? Do you know right off the top of your head?
We're at about 1.7 million.
Wow, that's a lot of boxes.
It's a lot of boxes. Yeah, a lot of metal boxes all around.
And
the
empty
country.
wine bottles.
Man,
People save the strangest stuff. It's just.
I really do.
Well, I mean, you understand the industry completely in all sectors, and the biggest issue is the rise of property values and the prices that you're having to pay for properties. What are you doing to, number one, find the good value add stuff? And are you just having to deal with a little bit lower cap rates right now?
Well, I think the challenge of deal flow is systemic across all of the asset classes that we all focus on, whether it's single family homes, multifamily, industrial, self-storage. There is a lot of capital out there right now that wants to be allocated to hard assets. The stock market's getting very long in the tooth. We're seeing very much a pivoting of capital from traditional publicly traded equities into private real estate vehicles. Seeing a lot of cap rate compression, and therein we're having challenges with deal flow. Most of the deals that we source are through relationships, broker relationships, direct to seller relationships. That being said, though, we're still paying more than we used to a couple of years ago, and that's universal. One of the challenges that we're seeing specifically in the deal flow front is there is an historically low cost of capital out there, and people are paying what we believe are very compressed cap rates because their yield requirements has gone down. It's, do you want to make a 0 or do you want to make a 4? And they say, well, we want to make a 4, we got to get money out. So what we're thinking that we're seeing in a number of the deals that we're missing by millions of dollars are buyers are underwriting to what may or may not be untenably compressed cap rates when it comes time to sell. So as you guys know, the model will tell you whatever you want it to. And if you're buying a deal and you want to be conservative and you say that deal is going to sell at a 7 cap in 5 years time, and you make an offer based on those assumptions, you may not get it. Somebody else is going to come in and say, we're going to say this deal is going to sell at a 5 cap in 5 years. So they can pay exponentially more than the person buying the deal at a 7 cap in 5 years. So that is one of the many reasons why we're missing deals out there. We are still getting product. We're getting inventory that makes sense, that we believe has good risk-adjusted returns, but we're certainly not finding as much opportunity as we'd like.
Right.
Well, Jonathan and I had a local RIA subgroup meeting last night, and we're hearing that from the people in that room, the exact same thing, that they are constantly getting outbid, and then they're coming with cash. They're not looking to have any kind of financing, and that gets tough when you're trying to get into the commercial self-storage arena. It's hard to come up with that much cash. But you're right, we were having that discussion exactly last night, that there's a lot of capital looking for a home
and compressed timeframes to close. I mean, you usually see people like in the commercial space, like 60, 90-day due diligence. I mean, we're seeing more and more people closing at or inside of 30 days.
Yeah.
Crazy.
Yeah.
You can't do your proper due diligence in that short a period of time. They're just taking it, basically no inspections, so to speak.
Yeah, we were doing a lot of 60-30 contracts, and now we're doing more like 45-15 just to hope to be competitive. Sometimes 30-30, but that's not a lot of time to properly evaluate a $15 million acquisition, for example.
Jacob, I think it would be a good thing. We just kind of jumped into a conversation. There's people on here that may not know who you are.
Oh, come on. Everybody knows who Jake is.
We know who you are. Talk a little bit about your company, what you guys do, and, areas you're investing in.
Yeah, we focused on a lot of the food groups in real estate over the years. We've done a lot of single family residential. We've done adaptive reuse retail. In the last 5 years, we've mainly focused on self-storage. And the first round of storage deals we did were single asset syndications, and we pivoted to a fund structure. We did our first fund in June of 19 and closed that out at the end of 2020. We launched our new fund, which is underway now. We're about halfway deployed. We've got about $30 million in acquisitions this month in September, and hopefully a few more in Q4. But we're primarily self-storage investors and operators.
Awesome. What area of the country are you all over?
Well, we've got deals in our backyard in Denver. We haven't bought anything here for a while because the market just hasn't made sense to buy. Mainly outside of Denver, we're in the Midwest and Southeast. So a lot of stuff in the Florida Panhandle, North Carolina. We've got properties in Michigan, Columbus, Ohio, Illinois, Tennessee. So we like the Midwest and Southeast because we found that those are a good blend of current yield, but with also a component of capital appreciation.
Right. Awesome.
Yeah, I'm thinking that the Midwest, you have a few more expenses that you have to deal with snow removal and that type of thing.
Yeah, snow removal is a big one, but another big one, especially in the Midwest, are property taxes. That's a huge number, and if you are not accruing properly for a worst case scenario property tax bill, your deal is going to suffer when it gets reassessed.
Wow.
So big tax bills in the Midwest for sure.
Wow.
Well, surprisingly enough, South Carolina is not very investor friendly when it comes to property taxes as well. They're very friendly to the owner occupant of a residential property, but I was surprised to find out how unfriendly they are.
Yeah.
And investor property, especially when we just got our recent tax bill for this building.
Yeah.
Yeah, it was nice.
So what size, or let's put it this way, number of units, when you have a criteria that you're looking for, how many doors or what kind of square footage are you looking for in each project?
Yeah, we look at it more through the lens of net rentable square footage versus unit count, because unit count can kind of vary based on the submarket. If you've got a higher size average unit mix, your unit count's going to go down, and vice versa. Our sweet spot is generally 45 to 50,000 net rentable square feet. We'll occasionally go lower than that if we're buying a property as part of a portfolio and we can achieve some geographic concentration, but we're not targeting one-off deals in new markets that are below 45,000 feet.
I know you're limited. I'm sorry.
Oh, no, you're
I know you're limited as to what you can really say about your fund, but I think a lot of people would be interested. You said you started a fund, then you closed it out in 2020. Yeah. And now you've got a new one. So if investors are interested in investing in your fund, talk a little bit about what it's like, why it has a drop dead date on it, and why you're doing a new one. How does that work?
Yeah, our funds are very focused on income first and then capital appreciation second. Income's a lot easier to quantify and predict than cap rates, 5, 6, 7 years down the road. We have a fairly standard waterfall structure. We have an 8% accumulating preferred return, and we curate our portfolio in a manner where we can distribute that quarterly out of the gates from acquisition. After 8%, every excess distribution goes to return investor capital accounts. So in short, investors are receiving 100% of the distributions the fund makes until preferred return is satisfied and until their money's back. And after those two things occur, the split with investors is between 70-30 to 80-20 based on how much money they invest.
Wow. And are you refinancing it at that point?
We are not refinancing as part of our model. We certainly could, but we're getting some very attractive debt terms that don't really call for a refi. Our last round of debt was at 3.8%, 10-year fixed, full-term interest only. So from a dividend yield perspective, there's different philosophies on amortization versus interest only. Amortization is good in that you're burning off principal in the loan, but amortization is not distributable cash flow. The only way to monetize that amortization is to either refinance or sell. So that's why we found the interest-only vehicle a little more attractive. So unless interest rates go down a lot, which is almost impossible to say or imagine if they get much lower than they are today, we don't need to refi. And if rates stay the same, we create some value, we would consider doing that to distribute some capital back to investors. But that's not a liquidity event that we're underwriting to in our model.
Wow.
So after that 10-year period, are you is your exit from those properties a sale, or maybe at that point a refinance? And
yeah, we get a few options on the exit. Our primary objective is to return investor capital within reason as quickly as we can, and that's not necessarily tied to a disposition of the asset base. So we're underwriting to a staggered one-off sale of each property beginning on year 6. Other scenarios might be a recap of the entire portfolio, giving investors the option to step up into new co at a tax-free basis or increase in basis, or have a liquidity event. Another option potentially is to sell the entire portfolio to a larger investor like private equity or institutional capital. So we've got a couple different options on the exit side, and of course a refinance, as you mentioned, Bill. But our plan is to hold these for a while and enjoy the repeatable, durable income streams that we think self-storage offers.
Are you putting more than one project in a fund, or are you doing a fund per project?
So our fund, there's obviously 2 types of deals out there on the capital raising side. There's single asset syndications, which is one deal, one LLC. And there's funds, which are identical to a syndication, but a fund is generally a collection of assets. And the reason we like the fund strategy a little bit more is the geographic and cash flow diversification that a multi-property portfolio offers versus one deal. So inevitably in a 10-property portfolio, 2 deals might be behind forecast, 6 are on forecast, and 2 are ahead, and they all kind of balance each other out. So our fund is a multi-property strategy. So far this year, we've acquired 9 self-storage facilities, which represent around $45 million in gross capitalization. We've got $30 million in acquisitions on deck for September, and then we've got a few deals that we're chasing for Q4. So by the time the fund closes, we'll have between 13 to 15 properties.
Wow.
Nice. Well, I mean, that's always the best strategy, is to be diversified as possible. You're diversified geographically, and then you're diversified because you have, obviously more than one property that's involved. It's no different than having somebody that has 1 rental property or 5 rental properties. If you're doing single family homes, or if you're making loans on 1 property versus 25 properties, inside of a fund structure.
Yep.
It's always the best way to go if you can have multiple assets.
Absolutely.
Great deep dive into a fund. People don't
awesome,
get to hear this.
You still have, are you still raising capital on your second fund?
We are. We're getting fairly full for our September allocation, but we've got room in Q4. So we'll probably close the fund out around $35 million. And end of September, we will have deployed about 28 million, 29. So another 5, 6 or so to go for Q4. So we've got some bandwidth still. And it just kind of depends on capital raising and deal flow, both of which are never, as you know, perfectly in balance.
We feel your pain.
The pendulum we know too well.
Yeah, it's always too much money, not enough deals, and then the next day it's too many deals and not enough money.
I remember I was telling our loan department before I went on vacation. We were in the same thing. We're like, all right, if you have to fund just 1 deal, this is the one you fund. And then when I got back, it was like, we need to fund 20 deals. Where are we at? Like, it swings that fast.
Doesn't take long.
Yeah.
Yep, couldn't agree more.
Listen, that's been this business ever since I've been in it, and it's nothing new. It's funny. It always works out.
It does.
No matter what, it always works out. So
it does.
Capital is typically, people who first get in this, they think that is the hardest part. Capital is the easiest part.
Money's everywhere.
It is mindset and opportunities. So those are the things that you have to, take hold of.
Mm-hmm.
Yeah.
Capital's always there.
So if anybody needs to get in touch with you about getting into the fund, do we have the proper URL for them to?
Yeah, you do. The website's great. And whether you want to work with us or not, it's always fun to talk shop about real estate if you want to bounce ideas off of us. LinkedIn's a good place, Jacob Vanderslice, or you can email me. It's jacob@vanwestpartners.com.
All right. Excellent.
Awesome.
Well, I love your business model.
I do too.
One of the things that I don't like about the syndications is obviously it's still one project. And the thing that you talked about earlier is trying to predict the value of the property at the liquidity event at the end when everything's finished. If your return is heavily weighted on the end value, you have no way of knowing if that's going to be the case or not.
Mm-hmm.
You might have of course, we can't predict the black swan events like we had with the pandemic, but that's why I like the income model on the front end.
Exactly. You have that.
That's much more predictable.
You have that predictability. I see so many of these funds set up, and it's like, all right, for the first 4 years, you're not going to get any income, but you're going to make 30% on your money at year 5. And it's like, there's a lot of things that can happen between now and year 5.
Yeah, one of our infamous one-liners is our models are always wrong. They're either wrong in the right direction or wrong in the wrong direction, but nothing goes exactly like you think it will. And for those of us listening, as you're considering investing in private real estate vehicles, whether it's a fund or syndication, there's a couple things you should look at. And one common term that kind of universally expresses the return profile of a syndication or a fund is something called IRR. And IRR stands for internal rate of return. And that's basically a time-weighted calculation based on a series of cash flows. It's almost like an annualized return on investment. And IRR can sometimes be massaged in ways that make a deal look better than it might actually be. So I'll give you a quick example. So Bill, you give me $100,000 today. In 6 months, I give you back $150,000. You made a $50,000 profit on 100. You did it in exactly 6 months. That's 100% IRR because you did a 1.5 multiple in half a year, right? That's a good return. That's a good multiple. So same example. Let's say you give me $100,000 today, and tomorrow I give you back 101. So your IRR is 365%, which might seem like a great return, but you're not happy because you only made $1,000 and you got your money back. So as folks look at different opportunities out there, don't just think about IRR. Also look at your total multiple on your invested capital. And by that, I mean, how much profit will you realize over the life of the vehicle as a percentage of the money you put into the vehicle? Mm-hmm. And when does that profit occur? So for example, on the multiple side, let's say that we could, or Bill or anybody could double your money in 5 years. So if you doubled your money in 6 years, that's still a really good return. You're happy whether you do a 2x in 5 years or 6 years, but in the 6-year scenario, your IRR or your time-weighted return is going to be substantially less. So as you examine these different vehicles out there, try to balance that total multiple over the life of the opportunity against what is probably, hopefully, a healthy IRR, but also understand when those distribution events happen. And to your point you made earlier, if you're looking at a deal that's a 50% IRR, but 95% of that return is predicated on an event 5 years from now, that's not a very safe assumption to make. So try to look at opportunities through all those lenses, and you might find yourself being a little more informed on various risk profiles.
Mm-hmm. So for all of you out there who like Excel, what Jake just said is, if you take someone's IRR model and then you use Excel and use the X IRR function, the X takes in the time into account. So then it quantifies that return based off the time exposure of the investment. So that's when people send me pro formas with IRR returns, I rerun them with an XIRR, with the dates of the allocation of the capital coming in, and then it blends that with the time frame. So that is, if XIRR, that's the function, the formula in Excel that you would want to use to do exactly what Jake just said.
So in a future show, we're going to have a webinar on how to set up your spreadsheet.
That would be a bad idea.
What Jonathan said.
It wouldn't be a bad idea. I always thought it was kind of funny, especially when we were doing a lot of one-off loans. People would give us money to lend out for them out of their self-directed IRA. And I was always amazed at the people that were really excited when it paid off in less than 30 days. It's a 6-month term and it pays off in less. They're all excited. And I'm thinking, don't be excited. You're having to work to put it back out again. And the time that you're missing to be able to do that.
Yeah, you've got downtime on your money because it's back in your bank account, and you have to find a new place to put it to work and take a new round of risk.
That's exactly right.
That initial pleasure is, hey, I got my money back and I made a little bit. Now what do I do with it?
Now what do I do?
And then to your point on making $1,000 a day, that would be great, and there's nothing wrong with that. But you have to repeat it for 365 days for it to really make sense. And the likelihood that you're going to get it reinvested every single day and get that $1,000 is not very high.
Yeah, we have a second on that Excel tutorial.
Not to drill down too much more on IRR, but I can't depart the call without mentioning this. I discourage folks from just looking at IRR. Look at deals in a manner where, am I going to make a rational amount of profit over a rational amount of time given the risk profile? And you shouldn't invest in this deal over here because it's an 18% IRR and not this deal because it's a 15% IRR.
That's right. Not all about the algorithm.
Correct. Absolutely. Wise words.
Yeah.
I have human in there too.
You're right. You have a lot of people that are just chasing the best yield. The other thing that they have to consider, and this is the most important, is who is the sponsor? Are these people you want to work with? Do they have a track record? Are they chasing yield themselves, or are they just wanting to first and foremost have a nice, safe return of principal plus plus making some income.
Yeah, I mean,
as
one
well.
of the things you should always like Jake said it. You have 15% here. You know the deal. Someone else has a similar or maybe a slightly different deal, and it's 18. Your first response should always be like, "Ooh, sounds dangerous. Why 18?"
That's
Right.
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 Red flag.
What's going on there?
Yeah. I had an old rich guy ask me once, if I could put one thing in your pocket, would you want it to be IRR or cash flow?
Nice.
Yep.
That's a great
cash flow.
question.
That's
all
really
day
good.
long. All
Yep.
day long.
I like
Always
that one.
going for the cash flow.
That's
Yep.
for sure.
Jake, thank you so much for joining us. You
Always a pleasure.
always provide wonderful,
Intelligence.
wonderful content. Yes, you make us look smarter. Thank you for coming.
Well, Bill, every year I get less stupid. So I'm glad to hear that.
That's the goal, right?
Yep, exactly.
That's funny. That's actually true.
Yep.
We get so many battle scars. We smarten up.
No, sometimes you get to a certain age and you start getting more stupid. I didn't.
Yeah, we don't know. We don't know what to do. We just know more things of what not to do.
That's right.
Yeah.
Yep.
Yeah.
Absolutely.
I've messed up there before. Oh yeah, I've messed up there before too. Oh, and there.
Exactly.
Mhm.
Folks, thank you so much for joining us on the what is this? The Passive Investor. Oh man,
Passive accredited investors.
Passive aggressive show.
I was doing so well, Jake.
That's it.
We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Also, if you're a passive investor and you're accredited, check out Jake's information. His email info is over there in the
In the chat box.
Jeez.
And it's also on the screen.
It's
right
almost
now.
over. I promise. It's all there in the quick comment section and his URL. Don't forget to like, share, subscribe, hit the bell, and sign up for Wednesday with Wendy. Once again, folks, thank you so much for joining us. We'll see you next week.
Thanks, Jake.
Thanks, guys.